Alright, we're going to try again. Sorry I got a little bit waylaid there. This is kind of one of the things of making these home videos is that you can get interrupted when you don't necessarily expect to be. Anyway, as I recall, we were discussing Chapter 2 and specifically the current ratio and working capital and how they are pretty closely related because both of them uh, have to do with the relationship of current assets to current liabilities. I think I left off talking about how the current ratio is calculated, and that is the ratio of current assets to current liabilities, or current assets divided by current liabilities, as shown on the board. And you're hoping that this ratio is greater than 1.0, and I should say in terms of a true ratio, greater than 1.0 to 1.0. So in other words, you want your current assets to be greater than current liabilities, in which case the current ratio will be greater than 1-to-1 ratio. The working capital then is simply the difference between current assets and current liabilities, so it's current assets minus current liabilities, and again, you obviously want this to be a positive number as a result, meaning the current assets are greater than current liabilities. Now, another thing that we discussed in this chapter was in using T accounts. And in terms of asset account, like say cash, that its normal balance is a debit balance, which is shown on the left side of the T. If there was an expenditure of cash for some reason, then that would be shown on the right side of the T as a credit. And then at the end of the month, if that's the only two things that you had going, you'd have a $4,000 debit balance that would be shown at the bottom of the T, like it is there. Okay. And again, as far as the accounting equation, I mean, some of this stuff just kind of sticks around from chapter to chapter, so it kind of things build on one another. So again, like for example, a collection on an account receivable, you should know what that does, both in terms of a T account, a journal entry, what it does to the accounting equation, any of those three. So a collection on a receivable is a collection of cash, right? So collection on an account receivable is going to increase cash. Let's say it's $500. It's going to decrease accounts receivable by that same amount, right? So on your T accounts, for that collection, you would show an increase to cash of 500, a decrease to accounts receivable, or a credit of 500. And of course, as a journal entry, it would look something like this. The debit to cash as the first part of the journal entry, and the credit to accounts receivable, which was indented to show that it's going to be the credit portion of the journal entry, and is shown second. Now, some of you had some trouble with that. You were putting the credit entry first on your homework, but the convention is to put the debit entry first and then the credit entry. Let's say what's the impact of an expense on the accounting equation? This is something that tripped some of you up as we went through the homework and the quizzes as well. So let's look at something like supplies expense. And if if we have an adjusting entry for supplies expense of $500 at the end of the month, then we're going to have a debit to supplies expense, and as part of the adjusting entry, we're going to have an equal credit to the supplies asset account. Okay, so again, as a journal entry, we'd have the debit to supplies expense and the credit to the supplies account, the asset account. Now, in terms of its impact on the accounting equation, well, what happened here, we had an increase to an expense, a decrease to an asset. So when we look at the basic accounting equation again, and recognize that under owner's equity, remember we have retained earnings as part of that, and retained earnings includes net income, which in turn includes revenues minus expenses. So when you look at all that that's going on in the accounting equation, including the fact that net income is basically the product of revenues minus expenses, then an expense basically acts as a decrease overall to owner's equity, doesn't it? So this particular transaction of an expense, in this case, had the effect of reducing an asset called supplies, and it also reduced owner's equity by the expense of the supplies expense adjusting entry. All right. So that's chapter 2. And then we move into chapter 3. We talked about deferrals and accruals, right? And we need to recognize adjusting entries for both of these things at period end. So if you recall, a deferral is something that we have we've received cash, but the expense has not been recognized in the case of a prepaid, or the revenue has not been recognized in case of unearned revenue. So that's what we've got going there. So that's, and a lot of you got hung up on the idea of a prepaid expense being an asset, but believe me, that's what it is. You need to try to tie that in with things like supplies and insurance. Those are two of the most common types of prepaid expenses, and they are assets. They sometimes are called prepaid assets for that matter, but the technical correct term for them is a prepaid expense, because as it gets used, that asset is going to be reduced, and the way to do that is to expense, in other words, recognize what you have used of that asset. Now on the accrual side, what we have is items that have not been recognized yet because there was no cash payment or collection going on, but there was still a need to recognize a revenue or an expense. An example here is something like salaries and wages. Another example is sales on credit or services performed. Without receiving payment or even possibly billing it yet. Apologize for my writing there, but so with accruals, we need to recognize an expense or revenue even though we haven't paid out the cash in the case of an expense or received the cash in the case of a revenue. And again, and I guess to follow through on this, if you're given a problem, for example, on the sales end of it, where a service was provided at the end of the period, but the customer may not have been invoiced until the first day or two of the following period, and of course may not have paid the bill for another few days at least after that, it's important for you to recognize that a service that was performed at the end of the period is to be recognized as a sales revenue or service revenue of that period, and not the following period just because the billing and the payment occurred later on. All right. And so when we talked about deferrals and accruals, we had I think we may have already talked about the expense recognition principle and the revenue recognition principle, which basically says that we need to recognize expenses as they are incurred and revenues as they are earned, regardless of what's going on with the collection or payment of cash. So that's why when we say we're on a accrual basis accounting versus cash basis accounting, that's really the essence of it is this. And only accrual basis accounting is in conformance with generally accepted accounting principles or GAAP. All right, I'm going to cut this one off at this point. We're still in chapter 3, but I think we're just about halfway home. So we'll see you on the next one.